Ronald, how do you see the tariff landscape evolving in 2025? It seems like it's always changing, and it's having a big impact on the equity markets.
I think it's going to be a volatile story through the year, but the general course or general direction of travel is going to be broader tariffs at higher levels. And I think this is something investors have really not fully appreciated. For the last year, in my conversations, I've encountered a lot of people who said, oh, the presidential campaign talks about tariffs. It's bluster. It's a negotiating position. They won't do it. I've argued back that this is a core belief of the administration, that they fundamentally believe raising tariffs can bring jobs back to the United States, can reduce the trade deficit. And I think you should expect higher tariffs against China in particular, and broader tariffs. We know on April 1st, we're going to have a new report from the Commerce Department, Treasury Department, U.S. Trade Rep and OMB about global trade practices. And on April 2nd, we know we're going to have reciprocal tariffs imposed by the U.S. and likely tariffs on autos. And the president has talked about tariffs on semiconductors and pharmaceuticals. So there's more to come.
And let's go a little bit further. How will all these tariffs affect inflation and interest rates? We've seen what it's done to the stock market. What's going on over there?
Make no mistake, higher tariffs increase inflation and in the long run, probably increase interest rates, and they lower GDP. And importantly for investors, higher tariffs are actually bad for corporate profit margins. If you think about it, if you're the CEO of a company that's importing certain inputs or intermediate goods that you use then later to assemble into a bigger product, your cost of goods sold are going up. You might not be able to pass through all those price increases to your customers, in which case your margins go down. So this is negative for inflation, growth, and profit. And I do think you're seeing that in interest rates. If you go back well before the election, in September of 2024, the 5-year inflation break even, so that's just the difference between inflation-linked bonds and fixed coupon bonds, implied that inflation for the next 5 years would be 1.87%. As of today, we're at 2.52%. So the market has basically added 0.65% to the assumed inflation rate each year for the next 5 years, anticipating not only that tariffs will go further and wider, but that we will also see higher inflation after those tariffs. Just keep in mind, by the way, one thing I should caution on, when you raise tariffs, it's a one-year effect, right? You raise prices 10%, 20%. For the next year, you're going to have a higher year-on-year inflation, but after that year, it kind of anniversaries out. So it is a one-year effect, but then it feeds through to the rest of the economy and higher wage costs, et cetera.
So from an investor perspective, which asset classes or sectors are most vulnerable? What should they avoid?
Yeah, when I think about it, well, first of all, if I'm right that inflation goes higher, I also think that means the Fed probably does not cut rates this year. The market is saying we're going to get 2 to 3 rate cuts from the Fed. I think it's 0. If that's the case, fair value on a U.S. 10-year Treasury is probably closer to 5%. So you don't want to be investing in long duration instruments, which is interesting. Right now, the market's worried about recession risk going up. Historically, you protect yourself by buying long duration bonds because yields go down when there's a recession. I think in this case, the risk is higher inflation. So that's probably not where you want to be. You want to be shorter duration. In the equity market, the most vulnerable sectors, in my view, are consumer discretionary retailers. Think about, if you're going to Target or Walmart or any of these kind of stores, a lot of the products they sell that are not groceries come from China or other emerging markets where there are going to be higher tariffs. So I think those companies are more vulnerable that as they raise prices, they get less traffic in their stores, smaller tickets in terms of what people buy. Less vulnerable might be financial services, energy. If you think about it, the big banks don't import anything, right? The big energy companies in the U.S. are probably going to benefit from exporting more energy in the years ahead. So maybe those are the two ends of the spectrum with a range of different sectors in between. And by the way, you always have to be careful. Each company might have different circumstances even within a sector.
You're talking about companies. Let's talk countries. Can you talk about how geopolitical tensions between the U.S. and Canada and the U.S. and Mexico and the U.S. and Europe, U.S. and China, how all these triangulations are going to play out?
I think what's really interesting is even in the last 2 months, the changes introduced by the new administration might have created a watershed moment in Europe. I mean, to me, one of the bright spots coming out of all of this trade turmoil, and by the way, we still haven't even imposed major tariffs on Europe, is that the Europeans, because of our discussions around NATO, have awakened from a slumber. In fact, even today, the Bundestag in Germany just passed legislation to change their fiscal situation to allow any spending above 1% of GDP to be excluded from the debt brake calculations. They also passed legislation to allow a 500 billion euro infrastructure fund. So I think you're seeing positive things coming out of Europe, in response to the geopolitical tension with the U.S., in response to our complaints about their funding of NATO, which I believe are well-founded complaints. In the case of Canada and Mexico, it's a bit tougher. 20% of GDP for each of those countries is exports to the United States. Now, in the case of both of them, the administration said the reason for the tariffs was illegal immigration and fentanyl trafficking. To be fair, in the case of Mexico, we had a border security issue and we had a major fentanyl issue. 9,600 kilograms of fentanyl seized last year at the Mexican border. The Canadian border, 19 kilograms. So not really clear what the basis is for going after the Canadians, but bottom line, this is bad for their economies.
And then finally, are there any economic indicators that you feel you're watching and other people aren't? We're seeing a lot of things like tariffs in the headlines. What are we not seeing?
Well, the one thing I would say that I'm focused on that is not getting much media attention is watching a range of different indicators in the labor market. Now, everyone watches unemployment, everyone watches non-farm payrolls, average hourly earnings. But what I've been watching is from the job openings and labor turnover survey, the JOLTS survey, is the hiring rate and the quit rate. Now, most people focus on the job openings rate, which I think is important. It's come down pretty materially, but still quite high relative to history. 1.1 open jobs for every unemployed American, down from a peak of 2. The pre-pandemic record was 1.25. But what I'm watching that makes me a little more worried is the quit rate. So the percentage of people who quit their job voluntarily each month has fallen from 3% 3 years ago to 2.1% now. The 2 years before the pandemic, the average was 2.3%. Now, why would a quit rate go down? Because it's not easy to find a job that pays you more money. It's a clear sign that there's a kind of an easing of tightness in the labor market. We're back to 2017 levels when the unemployment rate was 4.5%. The hiring rate, though, is the more worrisome one. We're back to levels of 2013 in terms of the percentage of people getting hired each month. In 2013, unemployment was over 6.5%. To me, this is a signal that employers are reluctant to add headcount because they're not certain about the future. And by the way, going full circle to our trade discussion, when you have constant changes in trade policy and you have uncertainty around government regulations in general, you're not willing to go out and hire people because it's hard to get rid of them once you've hired them. So uncertainty is the enemy of growth, and I think you're starting to see those cracks in the labor market.
All right, well, thanks a lot for coming on and talking about it.
Thanks a lot.